Welcome to Retirement Decoded with your host, Scott Tucker, where we break down the complexities of retirement planning to give you clear, actionable advice. Whether you're just starting out or getting ready to retire, Scott's here to help you make informed decisions and secure your financial future. Tune in each week as we simplify the process and decode the path to a stress-free retirement. Now, here's your host, Scott Tucker.
Welcome to Retirement Decoded, the podcast with Scott Tucker. I'm your host, Scott Tucker. My associate advisor here at the ready on microphone number 2 is Associate Advisor Andre Hootie. Say hello, Andre Hootie.
Hello, Andre Hootie.
Andre, we have a question from Walt, and Walt writes the program. Walt says, "Hi, Scott and Andre. I am 10 years or less from retirement. We always hear time in the market is better than timing the market." Andre, what does Walt mean when he says time in the market is better than timing the market?
Well, you never know when it's going to be a top or a bottom of the market. So waiting to to get in at the bottom or at the top, it's never going to work. So what he's really trying to say is, or what that saying is that if you consistently invest in the market, and you have a strategy, you're going to do a monthly, you're going to do a yearly, whatever it is, being consistent and being in the market for a prolonged amount of time, it's going to be better than trying to catch those tops and bottoms, because even the best traders in the world can't do it consistently.
All the research shows that trying to time the market does not work. There's a reason why Jim Cramer's on CNBC.
Yeah, he gets paid to talk.
He gets paid to entertain. So if timing the market works, why would he still be working?
Yeah.
Why would he be rolling into the studio at 4 a.m.?
Yeah.
In New York.
Exactly. He'd
or New Jersey, rather. Yeah. So Walt says, "Hi, Scott and Andre. I'm less than 10 years from retirement. We always hear time in the market. And I wouldn't say it's better than, I would say it's more important than timing the market. Time in the market is more important than timing the market." Andre, a lot of times folks get scared. We've seen it. Oh boy, have we seen it. We've had folks come see us at the office. We're in Chicago, Illinois, and we help folks long distance too. We've got clients, and for instance, we've got clients in Florida that have never been to the office, and we can work through DocuSign and Zoom and all this kind of stuff. But we've had folks that have been in cash since 2008, and wow, so that's time in the market's better than timing the market. Getting out is one thing. You might even get out at the wrong time, and then you don't know when to get back in. Also, during COVID, if you recall, there was a thing with COVID where the market, the U.S. stock market fell 30%. And then, so a whole bunch of people sold, and they'd already lost 30%. Mm-hmm. And then all of a sudden, pretty quickly, with less than a month, a couple of weeks, the Fed said they would buy everything, including the S&P 500. And they would buy everything. And then the market shot back up and even went higher. And folks sold at a 30%, they kind of had a 30% correction. They sold there. They didn't know when to get back in, so then they had to buy in later when it was higher.
Yeah, I mean, they waited till the news started telling them, hey, things are okay. And by then, when the news is talking about it, it's probably too late.
Well, it's a history lesson then. So they lost 30%, and then they missed a big swing up too. So they just did nothing but lose money. Mm-hmm. They lost more money by jumping off at the bottom, and then you don't really ever know when the bottom is. So Walt says, "Hi, Scott and Andre. I have less than 10 years to retirement. We always hear time in the market is more important than timing the market," rewording that as we go. "But as we reach the point where our income will come solely from our investments, we lose that time factor for our immediate needs." So it sounds like, and this is one of those questions that goes on for like 10 sentences in one paragraph. It sounds like Walt is concerned if he retires and he has too much risk in his portfolio, might be what's really going on here. He might not have ever done any sort of risk assessment or to see where he is. And then he's worried about, if you retire and the market goes down 30%, and then next month you still want to take the same amount of money from your investments, you're forcing yourself to sell at the bottom.
Yeah.
So maybe we just need to look at some hedging strategies for Walt. Walt, you can get on our phone calendar at tuckerretirement.com. No cost, no obligation. I have become obsessed with risk of returns.
Well, that doesn't.
He might have had a Freudian slip here. I'm just going to read the way he wrote it. "I have become obsessed with risk of returns and done some research." Do you think he means rate of return?
I would I would assume maybe, or maybe sequence of returns. It could
sequence of returns risk might be it.
Yeah, that might be. But
we have people oftentimes write the podcast and they have a bunch of typos and they don't proofread. It could be what's going on with Walt. I have become obsessed with risk of returns and done some research. I think you mean sequence of returns risk, which is kind of a wonky thing.
Yeah, it is. Yeah. It's hard to explain without really seeing it visually, but
unnecessary risk. Not only is it unnecessary, but we have seen folks where they have unnecessary risk and they go into retirement. It's not like when you're 40 years old and you're on the job and you have your 401k or Roth 401k you're just plowing money into. And so it could be sequence of returns risk could be what he's concerned about, which we do have to use some hedging strategies as we get closer to retirement. We have had 11. This is him stating all this. Okay, not me. I don't want to be labeled with what he says. We have had 11 10-year periods since 1927 where investments in the S&P 500 declined. There's been periods where they went up too. I think it has to do more, Andre, with what your time horizon is. I don't know how old Walt is, but he's saying he has 10 years or less to retire. Years to retire. We have had 11 10-year periods since 1927 where investments in the S&P 500 declined. That sounds like a lot. That would be 110 years.
Yeah.
He says that's why I didn't want to get in with what Walt's saying, being his fact checker, but I got to fact check him. He says we have had 11 10-year periods since 1927.
That's very subjective, though, right? You can pick any. I can go from 2013 to 2023.
No. But what I'm saying is take 11 times 10 is 110 years, and he says since 1927. It would have to be the year 2037, and all of them would have to be down periods.
Yeah, well, I think
so. You know what you're doing.
I think it's being very selectively selected because it's from 2022. As an example, let's just say from 2012 to 2022, that was a 10-year down period. Well, then he could also be measuring from 2013 to 2023 and say that was another 10-year down period. Let's say
Andre.
That was true.
You're stepping on the point. You're stepping on the lead here.
It's just
we have not had 11 10-year periods since 1927. It would have to be 2037 right now. Even if you're listening to this podcast in 2037, or right, it doesn't make any sense. So just get rid of that. That's Walt goes on with more statistics. That's nearly an 11% chance that the year you choose to retire could be a lost decade. The year you choose to retire could be a lost decade? Oh, Walt, come on now. Walt, why don't we just talk about some hedging strategies? Now, there are ways to, there's all sorts of ways. You can use options. You can use all sorts of different things. We could build a hedging strategy for you so that you wouldn't have all your money at risk in a down market. I think that makes better sense. 10 years or less to retirement, why is all your money in the stock market? That might be what's going on.
Yeah.
Or why is it all in the stock market unhedged? Or, let's talk about some other things Walt didn't mention, but some things people overlook. A lot of times people will tell us, Andre, well, I wanted to eliminate risk in my portfolio, so I put all my money in bonds.
Yeah,
Actually, we just saw that about a week ago, didn't we?
Yeah, we did, and that portfolio did not perform well.
The portfolio is down, which is just nuts. Another thing, people will say, I don't want anything risky in the stock market, so I put all my money in high yield bonds. Andre, high yield bonds are junk bonds.
Mm-hmm. Yeah, they have higher credit risk than the non-junk bonds. So,
like U.S. Treasuries are guaranteed by the full faith and credit of the U.S. government, not specific advice. Your mileage may vary on that one, but we have folks all the time. Walt, you're right in some things and wrong on others, and that's okay. But I always hear time in the market is more important than timing the market. And his whole thing's about worry about risk, isn't it?
It is. Yeah. He doesn't necessarily say that, but yeah, risk is important, and here's what we'll say. Throughout, you've been saving since, you started working in 401ks and whatnot, and those tend to be a lot riskier. So I understand why you're getting concerned about the risk as you get closer to retirement, because you've probably seen that account go up and down and you had to wait for it to come back. But as you get closer to retirement, you don't necessarily need to get out of the market. You just might need to look at your investments and see if they still make sense or if maybe it's time to reallocate. One
thing that sticks out, well, I don't want to be, unduly self-promotional or any kind of thing. You're a smart person, but you don't know what you're doing. And that's okay to not know what you're doing. We were looking at, I'm a little unhappy with our asphalt driveway right now. And then I was talking to a neighbor of mine, and he goes, "Oh yeah, we could tear all this up, and we could put in a heating thing to it, and we could rig this and rig that, and then we could, because we're in Chicago, so a heated driveway is a nice thing. And then we put the concrete over it, but you got to be careful if there's ever a problem with like a leakage in the doohickey, then you got to tear all the stuff apart and all this stuff." And I go, "Should me and my Yahoo neighbor be doing my driveway, Andre?"
Probably not.
Should I write an email to the concrete contractor?
Yeah.
To talk about me on his podcast about what a knucklehead I am. No, it's just, Walt, you're a smart person. You save money and all that. But you know what else is going on, Andre, too? We're more emotionally charged about our own money than anybody, more than we should be.
Mm-hmm. Well, you've worked all your life to save it. I don't blame you.
My mom was an operating room nurse, a registered nurse, and they had a rule. She worked at Sparrow Hospital in Lansing, Michigan, on Michigan Avenue. And they had a rule that if you ever had a friend or family member in the operating room, you were not on that case because you wouldn't be thinking clearly. You wouldn't be thinking you could work on somebody else that you didn't know, wasn't family, wasn't a friend, and everything would go so smoothly and so stress-free. But if it was your uncle, if it was your neighbor, if it was anything, they noticed that people did not perform correctly, didn't handle stress or anything. They actually created stress, kind of working on their family, Mm-hmm. And so, what can happen is you can try to do this yourself and you can mess it up. And I think whether it's us or somebody else, you need even if, we'll do a free phone meeting with you at tuckerretirement.com and get on our phone calendar. We'll just talk to you about it. And you probably don't like me much after hearing all this on the podcast, but we don't want to see you get hurt. We see too many people get overconfident or go off half-cocked or do what their neighbor did, or their brother-in-law, Bob, said to do this. Well, Bob's got money, and that's not the way to do it. Andre, we had somebody the other day that the gentleman he's a smart guy, like an IT professional. He's done a few things. And he says, well, my wife and I, they were at our office together in Chicago. Although we help people all across the country, we do Zoom meetings and DocuSigns and things like that. But he and the gentleman and his wife were at our office, and the gentleman was managing all their money. And they saved about $2 million of investable assets for retirement. Done pretty well. They live in the North Chicago suburbs. And the guy says, "Yeah, but I haven't done near as well as my buddy who I go on walks with. He's like bought and sold companies. He's been an entrepreneur, and he's got like $50 million. And he said, I should do, it was funny what the guy said. The guy who had $50 million said to his friend who has $2 million, he said, "I don't know how much money you have, but you ought to put $1 million in an annuity." That's what he told him. And I go, wait, why do you want you to put money in an annuity? He goes, "Oh, he just said that's what he did. He put $1 million in an annuity." And I said, "But you said that guy's got like $50 million. He goes, "Yeah." And I'm like, I don't know that. We just want to go on a walk with somebody who's not a licensed financial planner. And just because he put $1 million in an annuity, that I go put half of my money in an annuity. Like if you have $2 million, that's half your money. Yeah. To the other guy, it's 2% of his money.
Right, significant difference.
But we have that all the time, Andre, don't we? Where people will say, "Well, somebody's really good with money." Well, the guy you went on a walk with. He didn't make his money as a financial planner. He made his money buying and selling and starting businesses and selling those and flipping businesses. That's totally different. That's a totally different skill than it is getting from where you are now to where you need to be. So, well, whether it's us or somebody else, I would say most financial planners will offer you a free consultation. And what we'll do too, when we talk to people, Andre, that we can't help or don't need our help, we tell them that. We actually just talked to a gentleman a couple of days ago. He wanted us. He has 4.5. He and his wife have over, $4.65 million saved for retirement, and we weren't a good fit for him. So we told him that. It's not that we couldn't do it. It actually, I don't like to say this. It wasn't that we weren't a good fit for him. He wasn't a good fit for us. The gentleman with the $4.5 million, because his wife, when talking to them, his wife is super coachable. His wife already works the financial planner. Mm-hmm. The husband that we talked to, he's not acting like he's married.
Yeah.
The wife has a couple million. He has a couple million. That's their first marriage. They've been married over 20 years. They got a kid in college, and they're not acting married. The wife has got a financial planner and the husband refuses to use one. And I said, you know what you got to do first? Why don't you see if you can work with her financial planner? Mm-hmm. You guys act like you're married and be a family. And if you can do that, that's great. And if she decides, no, I don't want to work with this financial planner anymore, but we'll call him Fred. Fred, can you behave and can you be coachable? We would take you on as a couple, but we won't take you on as an individual.
Yeah.
And that's what that is. And a lot of financial planners say, that's nuts. But we have an established practice here, and we have to be choosy sometimes about who we agree to work with, because it might not be best for them. And what I hope the gentleman we talked to of that couple, the $4.5 million couple, I hope that made him think a little bit and maybe changes some things and maybe some behavior or maybe even the way they approach the marriage a little bit, because they're going to I told him, you were on the call with me. We're going to get a lot better results for you if you guys are on the same page. But with you guys doing two separate things, that's just not good. You could have one set of investments over with her planner, and then we could have one set of things going on over here. And we're trying to plan for a couple. We're not trying to plan for a husband, right? We want the husband and the wife planning together. We also do, I always say, I'm always careful to say we do help same-sex couples too. Because a lot of folks, I'd say a lot of folks, depending on what part of the country you're in, some folks seem not to understand same-sex couples or want to work with them. We're in Chicago, and so a same-sex couple to us is not at all unusual. We have a same-sex couple that are clients 5 minutes from our office, and we have our workshops in the community where we get everybody. We get widowers, never marrieds, people with kids, people without kids, same-sex couples, the traditional husband-wife couples. We have the so you know what? Speaking of that thing where the husband and wife are doing different things, we get a lot of this where it's man and woman and they're not married and they're handling all their finances separately, and then they want to act like they handle their finances together. Mm-hmm. They just don't.
Yeah,
that can be hard to do too.
Yeah,
yeah. Sometimes you got to just get married and get better harmony working together that way. So anywho, Andre, that's a lot, isn't it?
It is.
You think Walt's mad at us?
I hope not. It's things that are, they're not easy to talk about. They're not easy to hear. And sometimes it's not always the advice you want, but it's important, to treat it this way, because you aren't just yourself, right? You want to plan together as a couple.
You could just be yourself.
Well,
I kind of went on a thing because Walt didn't, I don't know if Walt said he was married or not. He said a we in there somewhere. Oh, no, he said we have had 11 10-year periods, which we haven't. So he didn't, but I just went on a tirade there. But hopefully that's information that you can use one way or another. Maybe it fits you. Maybe it fits somebody you know. Maybe it doesn't. But if you're looking at our phone calendar, we can talk to you off the podcast. We can talk to you and go through your situation. Just go to tuckerretirement.com. At tuckerretirement.com, you can see our phone calendar, schedule yourself right there, and then we'll spend 15 minutes for free in the coming week and get your questions answered and your answers questioned. If you like the podcast, hey, if you don't like the podcast, don't give it a review. If you like the podcast, give it 5 stars or whatever, share it on Facebook and whatnot, and we'll talk to you on the next episode of Retirement Decoded with Scott Tucker. I'm your host, Scott Tucker. We'll talk to you in the next episode.
Scott Tucker Solutions, Inc. has a strategic partnership with tax professionals and attorneys who can provide tax and or legal advice. Neither the firm nor its agents or representatives may give tax or legal advice. Individuals should consult with a qualified professional for guidance before making any purchasing decisions. A Roth conversion is a taxable event and may have several tax-related consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. The views and opinions herein are those of Scott Tucker Solutions, Inc. and do not necessarily reflect the views and opinions of AE Wealth Management, LLC. Investment advisory services made available through AE Wealth Management, LLC. AEWM and Scott Tucker Solutions, Inc. are not affiliated companies. Insurance products are offered through the insurance business Scott Tucker Solutions, Inc. Scott Tucker Solutions, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Scott Tucker Solutions, Inc. are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Scott Tucker Solutions, Inc. is not permitted to offer, and no statement made during this podcast shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Scott Tucker Solutions, Inc.